In the second video in the series, we're going to be using the amortization table that we did the first video to prepare the journal entries for the lessee. The lessee is the person who is going to take out the lease and use the equipment. Our journal entries begin on September 1st. September 1st, 2012, we have signed the lease, and since we have determined that this is a capital lease because the expected useful life, 4 years, is 3/4 of the lease. And under GAAP criteria, we have to treat this as a capital lease. When we have a capital lease, on the date that the lease is signed, we have to book an entry to show the value of the lease asset at its fair value. And in this case, we determine market price to determine that the fair value of the asset is $125,000. So we have a journal entry, a debit to our lease asset, and a credit to the lease payable for an equal amount. The lease terms call for us to make a cash payment on September 1st. We could have combined these two entries, but let's keep them separate. So on 9/1/2012, we're going to reduce down our lease payable by the amount of the payment, which is $4,111. Our credit is going to be to cash. During that payment on September 1st, there is no interest expense that is going to be recognized. That is going to change with the second lease payment. The second lease payment is due on October 1st, 2012. Again, we are going to debit lease payable. And that is going to be the amount of the principal reduction on the amortization table. In this case, $2,902. You will also recognize interest expense. So we will debit interest expense based on our table for the second payment at $1,209, and we will have a credit cash that is equal to our lease payable and interest expense. We will continue making these entries for every payment using the interest amount from our amortization table for our interest expense and reduction of principal column. That's all these payable. Let's jump down to the end of December. On the fourth payment, which is on September 1st, we recognize interest expense. Well, that interest expense covered the period from November 1st to December 1st. The interest for the period of December 1st to December 31st is going to be contained in the payment that's going to be made on January 1. Well, it's not when the payment is made that will dictate when interest expense will be recognized. Remember, interest expense, like all expenses, has to be matched to the revenue. So if we have a fiscal year ending, which we do in this case, we're going to have to recognize the interest expense the period of December 1st to December 31st in an adjusting journal entry. Signify these adjusting journal entries by AGE, and we're going to make these on December 31st, 2012. Now we're going to recognize this interest expense. And we're going to establish a liability for interest paid. Since we are carrying this leased asset as on our balance sheet, but we're going to need to recognize the expense of operating this leased asset. So we're going to have to make an adjusting journal entry for depreciation. Since the lease does not transfer the ownership of the asset to us, nor is there a bargain purchase option, we're going to depreciate or amortize this lease over the life of the lease, the 3 years. So our depreciation expense is going to be equal to the fair value of the lease asset divided by the lease terms of 3 years. So we will depreciate $41,667. The other side of the depreciation expense is going to be accumulated depreciation for an equal amount. So in our journal entries, we'll record the initial leasing of the asset with a debit to an asset account and an equal amount to a liability account. If we have a payment on the first day, that initial entry will show no interest expense. For all payments after that, we will go to a amortization table to determine the interest expense and the reduction in the lease payable. And at the end of any reporting period, we're going to need to make adjusting journal entries to recognize any interest expense that was accrued but not yet paid for, and to record depreciation based on the life of the lease, unless there is a transfer of the asset or bargain purchase option, in which case we will depreciate the asset over its useful life.